Good afternoon. Hello. If you're on the East Coast, I guess I should say good afternoon. If you're on the West Coast, good morning. And if you're somewhere around the world, welcome. My name is Doug Rammel, and I'm a serial entrepreneur and investor, as well as a former senior IT and operations executive in the healthcare, sporting goods, and consumer packaged goods industries. I'd like to welcome you all to August's rendition of our digital discussion, Connections Latest Connectors Conversation Panel, a webcast designed to bring thought-provoking perspectives and brilliant protagonists together around a timely topic to cultivate community growth. And we have some brilliant protagonists today. So today's topic is venture capital, private equity, and innovation in the digital post-pandemic economy. Brand building used to be contained or constrained within the four walls of a company, but in today's post-pandemic virtual economy, innovation happens in many ways, and new ideas can come from a myriad of sources. That need for new products and creative ideas has caught the attention of the investment community and is allowing us to develop new investment models, bringing startups together within the VC and incubator and accelerator communities. Our discussions today will cover both new consumer products as well as technology solutions, and we'll consider the role of big conglomerates compared to smaller startups and independent ecosystems. We will talk about how technology plays a role, particularly with virtual socially distanced collaboration and execution. When companies are able to globally source talent into teams to develop, design, manufacture, and deliver to markets, how does capital find its best, most optimal return, and how has the traditional investing model been impacted? Like as I said before, we have three brilliant speakers joining us to connect the dots. And although their current responsibilities are very different, they have all been intimately involved in multiple successive startups and have best practices to share. To start, each of them will provide a few comments about a key issue, and then I'll step back and let them chat. We may have time for a short Q&A, and for those of you who are watching this on YouTube, you can actually enter in a comment or a question, and we will then try to put it in front of our speakers if we have time. If we don't get to all the questions, we'll follow up with you within 24 hours. But first, a little bit about our speakers. Jerry Hayes, a longtime professor of practice, venture capital, and entrepreneurship at the Indiana University Kelley School of Business. Why don't we go to you first? A serial entrepreneur, co-founder, CEO of Dorio, and a founder of multiple startups. If you could wave, Jerry. We have John Seidel, entrepreneur, founder, CEO of a company by the name of eSync, a logistics software and consultancy firm that sold to Trans Systems in 2007 and now invests in and consults with startups in logistics and supply chain management and execution through his new firm, New Course Group. John, give us a wave.
Hello, hello.
And then Martin Suter, another serial entrepreneur and venture capital investor with multiple exits, but was recruited by Anheuser-Busch InBev into a global e-commerce and corporate VC role, about 5 years ago, 6 years ago, Martin? He's most recently returned to Nova Scotia from China, particularly Shanghai, where he led the B2C and B2B rollout efforts as global VP for e-commerce. So Martin, wave. So Jerry, we'll go to you first. I'm kind of curious, obviously, as a professor, we want to leverage your teaching and research activities. Talk to us a little bit about what is venture capital and private equity, what's been the history, and what's been your personal experience?
Sure. Well, thanks for the opportunity, Doug, and pleasure to be on with John and Martin for this session. Really briefly, venture capital is really new. In fact, the game of venture capital was invented back in 1946 with a single fund, American Research and Development Corporation. And it sort of found its footing into the late 50s and the 60s, and even into the 70s. In 1975, there was only $10 million of venture capital raised in the United States. So you had to go through some recessionary times, obviously the Vietnam War. There's a lot of pressures, economic pressures here in the United States. So it really wasn't much more than just a cottage industry. But things started happening in the late 70s and the early 80s when you had pension funds now being allowed to invest into venture capital with the prudent man standard changing. And you had companies like Apple and Microsoft and Genentech. You had the birthing of the PC with IBM going all in the early 80s. And then, of course, venture capital sort of flows with new innovations and technology. So you had the PC and life sciences, biotech as these explosive areas, late 70s, early 90s. You had the telecom in the late 80s, and then of course the internet, and then now mobile. And so you see massive amounts of capital go into these new industries because so many businesses get created. Traditionally, individual investors have been sort of aced out of this, and that's sort of the change in the 90s, where you saw more and more angel investors getting involved. And angel investors really is another word for accredited investors. You have to be be a millionaire net of house, or making a couple $100,000 a year. That was a rule that was established by the SEC in the early 1980s. But you've seen this massive influx of angel investors coming in and seeding a lot of ground floor startups, then handing those over to the venture capital world. And so there's been a symbiotic relationship that has been occurring with VC and angel investors. Now, obviously, angel investor activity is much higher in San Francisco, Boston, and New York than it is, say, in the Midwest. There's some other areas, pockets that are growing, Miami and Austin. But for the most part, you've seen venture capital and angel investing predominantly in these major three pockets of the United States. And that needs to change. And the next iteration is to bring everyone, even young investors, the Gen Zs and the millennials, who they stand to gain because they have 40 years of time horizon. They've got more, they can take on more risk, and they need to start learning investing early. We need to bring them into this because we are, as a part of an entrepreneurial revolution, and we need our young people involved. It just can't be millionaires, and it can't just be the 11,000 venture capitalists that are doing all the work. That doesn't scale. So that's what we're working on.
Okay. Well, so John, let me go to you. Obviously, you started a firm, right? And you were a relatively young man when you started your firm. If I remember correctly, you even had hair back then. So talk to us a little bit about what was eSync, how did you decide to do that, and how did you start it?
Yeah, good question, Doug, and thanks again for the opportunity to join the panel. I appreciate the time with Jerry and Martin, and thanks for the crack on the hair. Yeah, you get to a certain age where it turns gray or it's gone. So I think Martin and I know the gone portion of that.
Well, I certainly know the gray part, so go right ahead.
Yeah, so for me, I got started in the supply chain management space back in the late 80s on the software side. And basically have been able to have a front row seat to see that industry grow and develop. And as an example, one of the main players in that space, a company called Manhattan and Associates. And I got to know those guys when there was basically two men and a dog with an idea. And they grew that from the early 90s, went public in 98 and raised $300 to $400 million in during their IPO. So in that short period of time, literally 6 or 7 years, they just basically out hustled everybody and set the pace for this industry. So what I saw as an opportunity growing up in that space was to build an organization that kind of rode the coattails of the leaders from a software perspective into that market. And so I built this company called eSync that focused on deploying those types of solutions. And at the time, because some of this technology was new, organizations knew they needed something like that, but didn't know how to deploy it. And so taking a group of seasoned veterans that understood the benefit, understood the value prop, and really knew how to screw in the software to get the benefit that it was capable of is what we built that organization around. And grew it. I think first year out of the box, we did 15 million in revenue, went from 0 to about 80 employees in 1 year, all through word of mouth, all through kind of organization development and resources that we knew through the industry. And then sold that business in the mid 2000s and have since been doing what's called growth and exit strategy planning for other companies in the supply chain tech space. And now working with large private equity on what companies are good to buy, what is the right strategy for piecing together different types of technology and different types of firms so you can have a 1 + 1 = 3 scenario.
Gotcha. Okay. Well, so Martin, I mean, you're obviously a serial entrepreneur. You've been the little guy, and you've now kind of moved over and joined the big global player, and almost kind of formed or helped form their corporate VC effort. Talk to us a little bit about both of those.
So thanks, Doug and John and Jerry. Nice to be sharing the time with you guys as well. As you said, Doug, I've been fortunate to have been kind of a serial startup guy my whole career. Predating the Internet 1.0, kind of starting in the early 90s with application software, through the launch of the internet, enterprise software in the late 90s, rode the mobile wave, helped launch Web 2.0 in the social media space, and I thought I was done. I was in my early 50s, and was more focused on working with young founders and accelerators when I got a call from Anheuser-Busch InBev, from the chief growth officer there, who had just been asked by the board and the CEO to start a new group called ZX Ventures. And it was interesting for me personally and professionally, I guess, to have an opportunity to step into a role where our mission was to create a new business model, to explore new business models, ultimately figure out new business models, and build a portfolio of operating businesses for the company on a global scale. AB InBev is the fifth largest FMCG company in the world. It's the largest beverage company in the world. We're 30% larger than Coca-Cola, which surprises a lot of people. And that, of course, gives us a coverage and a visibility into opportunities and challenges, frankly, that I think are been pretty exciting. So ZX Ventures was founded 6 years ago. It was founded with four sort of different pillars, one of which was e-commerce and digital business. And I was brought in at the start of that to help launch and build that group. We looked at it. I think we realized very quickly that we didn't have all of the necessary skill sets in-house. As a large manufacturer, as a large FMCG company, and again, myself included, right? We needed to look outside for people with different DNA, people that were more entrepreneurial. And when we were looking to accelerate the launch of ZX, we did so by looking for great founders and businesses that would fit into a portfolio model. I led our first three M&A deals in Europe, which was a slightly more advanced market in terms of alcohol marketplaces in 2015. And when we found three great businesses there that we acquired at the time. I'll talk more probably later about the specifics of those deals, but what really interested us and me was these were great founders, and they were great founders that we were able to convince that by joining AB InBev and coming in under the ZX Ventures umbrella, we could help them achieve their dream. And their dream was building great companies and filling a need in the market and ultimately profiting from that. Subsequent to that, as you said, Doug, I moved to China, where I built a business there, sort of an organic business, over a course of 3 years in Shanghai. And we went from zero to very big in 3 years. And I'm proud to say it was the first of our businesses to achieve a scale whereby we had incubated outside of the mothership. And after 3 years, we were moving the needle. And we moved the team and the capabilities into the core business, and I'm now sitting in a different role with more of a global perspective.
Gotcha. So Martin, is it fair to say that the intent behind ZX Ventures was to bring innovation into Anheuser-Busch InBev and ultimately to try to catalyze change, or what was?
Yeah, I think catalyze is the right verb there, Doug. Innovation in any big company, right? Even in a big tech company, innovation is hard, which is why people, are engaged with, startup communities, no matter the business. I think in a more traditional manufacturing business, we would look for innovation along our traditional functional areas. So, whether it's something like ag tech or supply chain, marketing, martech, we're always looking to be on the leading edge as a customer, perhaps, of those businesses. And I think we have a reputation as being an early adopter of technology. But what's different here with ZX Ventures, Doug, is like these are new business models that we had never explored or tested before ourselves, right? And frankly, we didn't understand, how to do it, or the company didn't understand. So, we brought in experts and people that were doing it, and gave them capital. Obviously, funding is important, but I think more importantly, we gave them autonomy and got out of their way, right? Cool. So, a big key to the success was knowing that if we got too close, we could smother these entities. We could love them to death if we didn't give them enough space. And
gotcha.
And that was an important thing we did.
Gotcha. Jerry, let me go back to you, because obviously there's been a ton of innovation in the business of innovation, right? And clearly in the whole venture capital space, crowdfunding, obviously a rise of investment vehicles like Robinhood and Bitcoin and digital currency. Why or how have they impacted the VC, private equity, and venture world? And why have they succeeded? Why haven't they succeeded? And why is more change needed?
Well, so I'm going to start sort of with that sort of meme stock, Robinhood, crypto development, and private equity funding. So there's a lot of innovations that are happening. And what that's done is that's brought a huge wave of interest from young people that they now realize they just can't be consumers in an economy. They have to be investors in an economy. But when you're trading meme stocks and you're trading crypto, and I'll put crowd equity separate from those, is that it's sort of a win-lose trade. Either you're on the right side of a trade or you're on the wrong side of a trade. Startup investing, we're investing in entrepreneurs. It's win-win, lose-lose. But you're imposing your values, and you're bringing, what you want to see in the world. You're helping make that happen. And crowd equity funding was that innovation to now start that process of opening, non-millionaires into the startup investing world. It hasn't scaled the way we had hoped it would scale, and I think that ultimately, and I think both John and Martin would agree with this, to be a very good startup investor, you have to be incredibly diversified. You can't just put a little bit of money into one deal and hope and pray. You've got to take a little bit of money and put it into 25, 30 deals. And if you can do that at scale every year, you're going to build a successful portfolio. So while these innovations are happening, they're not happening fast enough, and they're not protecting investors enough. And I think that's why we have to. The answer to this is to get more aggressive with the SEC to allow them to make room for the early investors. And they started that, and they've allowed that with a new rule. Now it's time to execute on that rule.
Okay. So, John, let me ask you, obviously, supply chain has been a global pursuit, right? I mean, companies have gone around the world to literally find sourcing of new product. And they've also obviously began to use the world as a global customer. How have you seen that change the approach to capital, and how has that increased or decreased the need for startup capital in logistics and supply chain management space?
Yeah, so when you think about the global economy, right, the supply chain is really, in my opinion, a backbone of that. And then the backbone to supply chain is visibility, so inventory visibility. So where are things at rest? Where are things in motion? And so, Amazon has changed everyone's expectation on when acceptable delivery is of a product. 20 years ago, it was, hey, I can order it on a catalog and it'll show up in 10 to 14 days, and that was acceptable. And that's absolutely not the way the e-commerce world works now. So having that inventory visibility really is the crux of how you can have the ability to promise for orders that come in, as well as understanding, what orders you can fill and what the priorities of those are. So when you think about that in terms of an understanding, that's where there's been a significant influx of capital that's come into the supply chain management space. And for the ones that the smart investors that understand how important inventory visibility is, are the ones that understanding they can invest in point solutions, which is robotics and automation and those types of technologies, or they can truly understand which of these software capabilities and vendors out there have access to visibility at rest and in motion, and start with that as kind of that central brain of how they can invest, and then you leverage that to get into other ancillary types of technologies. But that's an important part of what's going on in the supply chain these days.
Okay. Well, so Martin, I mean, obviously it would be silly of us to not have you talk about what is venture capital like around the world. Are different economies, do different countries practice the startup process of business and the funding of that differently? Obviously, there've got to be different regulations, right?
Yeah, great question, Doug. And I think, one of the things that surprised me in China, for example, was how active and how aggressive the private equity model was there. I think people would be amazed at the vast amount of capital and private sector wealth that exists there, and and the willingness and desire to to invest and to participate. So whether it's accelerators or incubators, the startup scene was very, very dynamic. The check sizes were comparable or larger, and the valuations, frankly, are also in many cases an order or two magnitude greater than what you'd see in North America. I had a interesting anecdote. My first top-to-top meeting with the Alibaba senior leadership, I was hot off the plane, 40 days in, had just finished my 5-year plan, and I was invited to present it to senior leadership at Ali. And, my counterpart was very polite, listened to my presentation. And then at the end of it, he pushed his chair back, leaned back, and he said, "Well, thank you very much, Martin. That's, very interesting. Now add a zero." And I think that, as big and as bold as I thought I was being, that sort of informed how we need to think about markets like China. I think another example is a company called Rappi, which is fortunate to be an investor. We put $1 million into their pre-seed round in 2015, late 2015, early 2016, and Rappi's a Latin American-based e-commerce company, but also fast delivery, so solving the last mile logistics challenge. And these guys have done just an amazing job of scaling in countries like Mexico and Brazil and Argentina. And there's not a city in Latin America where you can't go and see people in Rappi uniforms all over the city. So they've done an amazing job. They just closed a $500 million round at a $5.8 billion valuation. So in 5 years they've gone from zero to almost $6 billion. And again, that's some American investors, of course. But it's also, they're also tapping into investment dollars from around the world.
Cool. Hey, Jerry, talk a little bit about the consolidation of VC capital, all right? I mean, I think it's a pretty well-known fact that, 75 or 80% of the deals that get done in the U.S. annually are in 3 major city metropolitan areas. And yet we have innovation happening all around the world, right? How do those two facts jive, and why is that?
Well, I think that the amount of venture capital is risen, significantly, right? And there's more capital under management today than there ever has been. But to your point, Doug, it's still consolidated in certain geographies and even in certain, I would say, generations, right? So 80% of all venture capitalists are, sort of middle-aged, white men. I mean, that's just the demographics. That started a VC and got into VC. It's changing now a little bit, but it's even the pattern recognition that happens within that group. They only tend to invest in certain schools and certain entrepreneurs and certain age groups and even certain genders. It's all changing, but it's not changing fast enough. And to your point, Doug, we're in a global economy. Entrepreneurs are coming from everywhere. And what I think that we need to be cognizant of is that if we take a look at our millennials and our Gen Z populations, let's add them together, there's 150 million of them, right? 70% of them want to be entrepreneurs. 45% own stock. Almost 40% own crypto, right? They're not to pay your dues for 20 years type of people, and then we'll let you into a club, right? We need to be letting them in now, and I think that would be transformative. I think it raises the tide for everyone.
So, John, let me ask you, obviously, how does global logistics work? I mean, you still have to get a product to market. You still have to find a customer, right? So regardless of where you raise the money, where you build the product, you still got to get it to that end customer. And that really is the business of logistics, right? And ultimately, what's gonna make the world a smaller place?
Yeah, I think that's been evolving for a long time, and I think what I'm seeing in this supply chain space is a real convergence of technologies. So there used to be, certain technologies like software that was its own thing. Then there was automated solutions, which didn't play with the software, but you screwed in highly automated type operations. And then the latest trend is robotics. And so robotics is really coming on strong. It's been in the manufacturing sector for a long time, but it's really catching significant tailwinds now into the supply chain space and logistics space, to the tune of organizations like Six Rivers, which is a robotic solution that got bought by Shopify. They were running at about a $15 million run rate and got a valuation of $450 million, so 30x what their revenue was. And then another one, I think it was Fetch, got bought by Zebra for a 29 times revenue. So there's just this significant investment going into automation and going into robotics and software in this space. I actually, while we're on that topic, I actually had a question for Martin about some of the investing that, from an ABI perspective, are you guys actually looking to invest and do full exits for some of these companies? Or are you actually taking getting an understanding of the technology that some of these companies have and putting in some seed money or some growth capital and then deploying them within ABI so you can increase the revenue and increase the value, and then potentially have kind of a win-win where you win because you have the technology deployed in the organization, and then win because you've pumped so much revenue in, it adds to the valuation for somebody else to come in and add more. I'm just curious about that strategy.
Sure, John, and I think the answer is all of the above. I think, in those examples that you cited, right, and I mentioned at the outset how we like to be a leader in innovation and how we work with, amazing innovators. So, we were the first to announce, long haul electric trucks, for example, commitment to purchase long haul trucks from both Tesla and I forget the other player. One's electric, the other is doing hydrogen. So we step up, we place commitments or publicly make a commitment to ordering 500 or 1,000 vehicles. You can imagine that coupled with some form of investment, would benefit all parties, and I think that's an important strategy. Conversely, we and then when we launched CX Ventures, I think the philosophy was that we needed to have controlling interests. We were building a portfolio of operating entities, so exits or full exits were, or at least path to control, was a necessity from a deal perspective. And I think that was the right model for those times. We're now kind of just evolving into, I'll call it ZX version 2, where we're 5 years in, we've learned a bunch of stuff, we've built and grown a bunch of businesses, and now we've set ourselves up with multiple funds where we act more as a traditional VC, placing multiple bets in key areas of interest to us. So to answer your question, it's a combination of all of the above, and I think there's a time and a place for each one of those, and certainly we take advantage of those.
Yeah,
Hey, Martin.
And that's actually what I've seen with other organizations as well, like Koch Technologies, the parent company to Georgia Pacific, Guardian Industries. I think they're close to $100 billion as a privately held organization. They started Coke Disruptive Technologies, which is exactly that, to invest in new technologies that they can use internally, and then get the win-win on the upside of the growth. Prologis, which is I think the world's largest real estate holder of warehousing space, same sort of thing. They've got, I think, 1 billion square foot of warehouse space, and they've got Prologis Ventures, which invests in new technologies that can then be deployed by their tenants within their organizations. And another one's Stanley Ventures, same sort of concept. So it's just, I think it's an interesting approach to utilizing good technology and vetting it, but then also having a significant upside on when it really takes off.
Let me jump in, guys. Jerry, I'm kind of curious from an academic standpoint. Can corporations do venture capital? Is that something? I mean, it sounds to me like it's almost kind of a walking and chewing gum, right? It seems like something that's out of character. Martin, you mentioned that obviously, and AB InBev is known for being a change agent as part of its operation, so it's kind of part of your culture. But Jerry, that sounds to me that that's going to be a culture class for a lot of companies.
I mean, I think Martin. I mean, they're starting to figure it out, and they're starting to get it, and they're flexible enough to see sort of the kind of the landscape and to course correct, for the best opportunities. I think that it's tough in venture capital inside a corporation because the incentives to be outside of corporate and to create your own fund, and you get the 2% and 20, the carry at the end of that. There's a real incentive, to be, flexible. I don't want to say necessarily aggressive, but it's a different view than being inside the corporate world. I mean, I think that it's a different mindset. So you have inside corporate, you have to kind of think about your decisions in the context of the company strategically, whereas in venture capital, your thesis is changing all the time, but you're not necessarily beholden to a larger organization. So I think it's, when you find people like Martin who understand, how this fits within the bigger scheme, it can be incredibly successful. It hasn't always been incredibly successful inside corporations, but I think it's one of those things you have to do it today, and partnerships are everything, right? And so when Martin's saying, I'm assuming, Martin, that now that you're dropping more lines, you're doing this in partnership with other VCs and building relationships and trusting relationships, and as you're curating that network, so you're in a position where you can be opportunistic when the time comes.
Very much so, Jerry. But I think I would add, as as being a strategic investor or being the strategic at the table, is also a difficult position to be in as well, right? Because in an ideal world, we would have some kind of right of first refusal or path to control,
Right.
when you're making a minority investment. But of course, that's not typically a friendly clause for the other investors, right? So I think we've had to sort of temper our views in an area like that, and be willing to sort of say, okay, we're gonna make an investment here because it's the right thing to do, and if we get into a bidding war because we've created something of value here, that may end up costing us more downstream to get control. That's a consequence that we have to accept, because otherwise we won't be at the table, right? We won't be welcomed in by the investment community, and that's something that we've had to learn, frankly, the hard way over the last 5 years.
Right. Yeah. Right. So let me ask all of you guys this. Obviously, we've moved into a new awareness of the virtual world, right, over the last 18 to 24 months. The pandemic, obviously, there were a number of trends that were already happening in terms of virtualization and digitization of function and teams and all those kinds of good things. But they all got a huge kick in the rear forward with the pandemic. How has that then changed private equity and venture capital from your guys' perspective? And is it literally possible to start up a company pretty much anywhere, using a team from anywhere, drawing capital from anywhere, serving customers everywhere? Who wants to take that first?
I wouldn't mind taking that one. So I think, being a supply chain guy, I've been talking about that for this whole call, but I think that the pandemic really accelerated why supply chain and inventory visibility is so important. I mean, I've got a stat here from, it's Crunchbase, that back in 2014, there was less than $1 billion invested in supply chain and supply chain technology companies. Less than $1 billion. Already through July of this year, there's been 7 billion. So in 7 years, and if you extrapolate that out, that's going to be probably an 11, maybe even a 12 or 13 billion dollar number for 2021. So in 7 years, you've gone from less than $1 billion to 12 or 13 or even more for 2021. And I think it just highlights the importance of what's going on with inventory visibility and in the supply chain space. So globally, what I've learned from and talking with some of the bigger PEs, the bigger ones are okay with taking more of a global format. The mid-tier PEs and VCs really right now are probably keenly interested in sticking regionally. So they may be intrigued by an Asian technology or technology in Europe, but they still like to stick within the North American environment because they feel they can have a little better control over it. And anytime you go international, it takes an infrastructure to be able to support that and also give support to the investment you're making. So oftentimes smart money is where where the investment comes from. And smart money means help from your capital partner to really leverage the technology you've got. And sometimes it's difficult if you're not in Europe to be that leverage point.
Yeah, I think that's right, John. And I think, the old adage that investors don't like to invest outside their zip code or certainly, outside of their coast, is still largely true, right? I mean, traveling from the West Coast to the East Coast for a board meeting every 2 months, is a big deal. And I think, that continues to be the case. Certainly what we've seen as well.
So Jerry, jump in here in terms of generational change, because I think some of the numbers that you threw out earlier in terms of the number of Z and millennial generation owning stock, willing to use and invest in the digital coin and other kinds of platforms, it sounds to me like they're primed to become virtual venture capitalists.
They are. I just don't think they're designed necessarily to make the direct investment in a company. I think that the financial industry overall has benefited from a middleman, and the venture capital industry benefits certainly from middle people. And I think there's this new concept called chaperone investing. And so, let's just turn around and look at John, for example. John is heavily involved in supply chain, and John is probably seeing at least 5-10 deals a month. And John could say, you know what, I want to set up a $10 million fund and I want to invest, and then why can't you get, 100,000 non-accredited investors each giving him $100 to invest? And John's he's got the dry powder and he's free to go. And John will stand on his credibility and his record of understanding the industry. But then, you get, even in small increments, you give these young people exposure to these technologies and these industries that are growing. I mean, it's mind-boggling to think what's going to happen over the next 20 years in terms of artificial intelligence, machine learning, robotics, decentralization. We can't just let our young people be consumers of these products. They've got to be investors in these industries. And if we don't do something about this, and I know I'm very passionate about this, but this divide that we're going to continue to create between the haves and the have-nots, it's just only going to get wider, and that's not good for our economy. So we have to find ways to allow even small amounts of money to get in the hands of experts like Martin and John, so they can deploy capital, in this sort of these fast-paced, high-risk, high-return, assets. And I think that the young generations want that. And I think it'll just spur more entrepreneurship in general. I think it will encourage more people to take ideas out to market if there's more early ground floor capital to do that.
Gary, just a question. Sorry, Doug, if I may be. So you talk about the young people and their desire to invest. I think, one of the things that I've seen are things like, NFTs, right? So I was talking to somebody recently who who bought a Bored Ape from the Bored Ape Yacht Club, paid $2,500 for it. It's now valued at $140,000. Right? We spoke offline about Dogecoin, and and people, millennials and Gen Z investing in those things. Do you really think that they're going to be interested in investing in like, say, old school fund kinds of bricks and mortar businesses, or are they going to just leapfrog that and go right into the metaverse and the world of NFTs and crypto?
I mean, that's a really good question. I think that as a society, I think we want to, push them towards long-term value creation through entrepreneurship, new businesses, new true real value being created. I'm not sold yet on the NFT, the craze. I think crypto is going to be around, but what I do think, Martin, eventually is that why couldn't you set up where you make an investment in a company and immediately tokenize and sit through syndication that investment so they can trade essentially the equivalent of an NFT in a startup, right? So it's almost like these small IPOs, if you will, right?
Also known as a stock certificate.
Exactly, but that's not the new words today, right?
I was thinking the same thing, because my grandfather had one of very first stock certificate of one of his early companies framed and up on his office, right? And that was the original NFT.
Yep. So a question for Jerry. So coming in from an academic perspective, so we talk about, and I was actually part of at the college I went to, I was part of their original entrepreneurial board. But when I think about being an entrepreneur, that's different than being a strategic investor or an investor that looks at technology and puts some money into it. Are there university programs now that actually help educate the college kids, so that when they're getting out of school, they're actually have some background and some understanding of what investment is, as opposed to just being an entrepreneur?
I'd like to say there is, but only a handful of companies out there really teach entrepreneurial finance.
Yeah.
IU Kelly just happens to be one of the leaders. When I started that class back in my predecessor, David Haberly, started one class in 2003. I started teaching in 2004, went from 2 classes. Now we're teaching each semester 8 classes of it because the demand is so high. And we get into the rigmarole of cap tables and dilution and different types of securities and how to do valuation and all of these nuances. And it's amazing how people leave that class from the beginning to the end, now really super interested in being a startup investor or participating in this economy. Right. And I think entrepreneurs, frankly, to be a great entrepreneur, you should be an investor in other entrepreneurs. You'll get a very good sense of if you're out raising money, what other investors are going to be looking for you, if you've had the experience of what you're looking for in other investors. So I think it's a great symbiotic economic situation that would really benefit our globe.
Yeah. So your comments earlier about the percent of the millennials and the Gen Zs that own stock in our investors in traditional investment platforms, but it would be really interesting to find out how many of them actually had some level of formal education on what investment's about, because oftentimes it's self-taught, or it's over cocktails. Somebody had a great investment and they share it with somebody else, which sometimes that can be misinformation or misleading. It'd just be interesting to really understand what formalizing the education around those topics would look like.
I think they call it the fool's tax.
Well, there's a reason you have the 3 F's at the top of the investment pyramid, right? I mean, so, but Jerry, talk a little bit about Dorio and what your plan is behind it and kind of what the story is.
Sure. Our mission is to get non-millionaires accredited or certified as accredited investors. So the SEC just changed the rules that allow an education path to becoming an accredited investor. And when you're an accredited investor, you could be invited into a venture fund if they would take in small amounts of money. You could be invited into any Reg D offering. You could be invited into real estate plays. I mean, there's lots of different opportunities that come with the accreditation. Now, the challenge is what the SEC cares about is we just don't want to open up the floodgates without some sort of protections. So we have to teach financial sophistication. And so what we've created is a high fidelity simulation that it's a mobile app on iOS and Android, where we put someone in the position of being a startup investor or an investor in Reg D offerings, and we give them 50 deals and $10,000, and then they have to make decisions on each of these deals. And each of these are real companies that have gone through the life cycle, and they can see the ramifications of their decisions. And what we do is that we poll people. We just launched it about 3 weeks ago, and we've had over 1,800 downloads, and we've gotten surveys back from probably 250 young people that have downloaded and played. And it is amazing how we are able to raise their sophistication from virtually nothing to understanding this market enough to decide whether they'd want to be an investor in the market or not be an investor. So we're bringing that data to the SEC. But just imagine, out of a pool of 150 young people, right? There's got to be 70 million people out there that are interested in entrepreneurship or in investing, or at least getting the accreditation. And what does it look like we raise the consciousness, the financial consciousness of young people? Even if they don't invest, it doesn't matter. We raise their smarts. And that's what matters to our society and our economy. It's a huge value add, I believe, to overall to the economy.
So if people wanted to look at Dorio, or they wanted to get on it themselves, where do they go? How do they get involved?
They can just go to Dorio.com. Right here, you can see just Dorio.com, and you can give you a link to download the app. Give it a try.
And I'm assuming old people can get on as well.
Absolutely. We've made it old person friendly too. That's simple.
So Martin, I'm curious from your perspective, right? I mean, how much longer do you think you're going to be involved in the corporate side of venture capital? And at what point do you think that you'll be called back onto the startup side, or are you able to kind of scratch that itch, sitting in the seat that you're sitting in now?
Doug, I think for me, my founder days are probably behind me. I don't know if I have another one or two in me, but I think where I've learned I can add value is by working alongside founders. So whether that's as an advisor on an advisory board, as a independent director on a board at a board level, I really see that sort of my next steps, if you will. I sit on a bunch of boards. I have sat on a bunch of boards, and I find that I really enjoy that level of mentorship. Sort of being an active mentor to young founders. I have lots of scar tissue. I have lots of experience that I'm willing to share, and frankly, I feel kind of a gravitational pull towards my contributive years, as a mentor once described his life. Kind of moving out of the productive years into the contributive years, and that's kind of how I see the next decade or two.
I got you. So, John, I would be remiss to not quiz you. So, at what point are the robots and the AI going to take over the world?
Depends who you ask. Some say already is happening, but the growth in those areas has just been phenomenal the last few years. And Jerry touched on a couple of key points around that: are AI, artificial intelligence, and ML being machine learning, and building software applications that can leverage those types of technologies and those types of data points are really what I'm seeing is a big growth within supply chain these days. And anything that can help cure some of the labor shortages, which if you spend any time in the supply chain logistics space, labor shortage is an issue for everyone. There isn't anybody that isn't complaining about labor shortages. And when we're wondering why we don't have toilet paper on the shelves, or the price of certain consumables has doubled or tripled, it's because of supply chain disruption. So having AI and ML and much better efficiency within those operations can speed up the throughput, can speed up the latency around inventory visibility and information, and create this digital twin, which is another word that everybody gets, or another phrase everybody gets excited about. But the better we can have the utilization of the resources, the faster we can deploy it, the faster we can get it through the supply chain, the better everything gets.
Hold on a second. What is a digital twin? Because to your point, I've heard it. What is that?
So it's in essence a replication of what's going on in an environment. Replication with zero latency. So where is that so in the warehousing and logistics space, where is that truck with what inventory on that truck right now? Not where it's forecasted to be or where it was an hour ago. Where is it right now? So it's like an Uber app, right? So when you call an Uber and you look and you see where that vehicle is on its way to get you, that's an example of a digital twin. But now apply that to a warehouse or a distribution environment where you know where every piece of inventory is inside of that building, and that's at rest. And then you also know where it is, either on the way in or the way out through trading partners. And the creation of that digital twin with zero latency for the supply chain is really one of the things everybody's chasing.
So it's basically almost a simulation or a virtual reality.
So simulation is where it's forecasted to be as opposed to where it actually is. So there's some different technologies out there that have really created an opportunity for true digital twin. So one of them is 5G. So 5G at its core is what's called ultra wideband. And anybody that's seen those little Apple pods that they're called, where you can actually attach them to a keychain, and through 5G, you know where it is in your house. So if your 5-year-old picked up your keys and took them from the office to the car, you know where they're at. And so imagine applying that level of technology to in motion assets, either in a distribution environment or logistics environment. You can actually create that true digital twin that's not simulated or emulated. It's actually the exact representation of where that is at that time.
Cool. But hey guys, it's been 51 minutes. I want to be respectful, obviously, of your time and our audience's time. So I'm going to kind of wrap things up here. You guys covered a ton of stuff. What I'd like to do is just go around one more time and say, throw out one thing that you think is going to change both over the next 6 months, and then what do you think is going to change over the next 5 years that no one's really talking about yet. From your respective area. So, Jerry, I'll go with you first.
Well, that puts a lot of pressure on me. What's going to happen? And lot's going to change over the next 5 years. I'll just stick with what I've been working on is the decentralization of finance and allowing the ability to purchase assets at much cheaper rates, and the migration for these young people being just consumers, but to actually be investors and to make investing as important as consumption.
Cool. Martin, what do you think?
I think, we've made some pretty big announcements regarding sustainability and have some major sustainability targets for 2025. Being carbon neutral would be an example. Clean water, agriculture, recycled or circular packaging and things. So, I think it's going to be incumbent on businesses like ours to lead the efforts to reduce our footprint on a global scale. And again, it's an area in which we are actively investing. It's an area in which we are actively innovating. And, and I think we have an opportunity, frankly, to do things that the governments aren't able and willing to do these days when it comes to sustainability and climate change.
John, your ideas?
Yeah, good stuff, Martin. Good stuff, Jerry, for sure. And for me, I think it's just a continued evolution of technology and automation. So that will allow us to do, be more efficient, be more transparent in terms of where things are and in what quantities, and just that continued evolution of efficiency within logistics is where that's where I live. Maybe I'm a one-trick pony, but that's where I spend my time, and that's where I think the next 10 years, the next decade is just going to be continuing evolution of that.
Okay. Well, hey, listen, guys, I really appreciate your time. I want to thank our expert panel, obviously Martin Suter, John Seidel, and Jerry Hayes. And we'd also like to thank both ProBook, which is an athletic team management tool, and then Legion Star, your partner to digital security and ERP consulting, for their ongoing sponsorship of Connections. For the audience, feel free to follow Connection on LinkedIn for more information about participating in our community, joining the community, as well as making custom connections and impacting the conversation. and then watch the Connection LinkedIn page as well as our general website, www.connection.us, for information about our September session, which will be focused on healthcare as a consumer product. A replay of today's conversation will be available on our site, and we'll be posting summaries of our speakers' perspectives. Thanks, and thanks everybody for participating.
Thank you.
Thank you. Bye now.